You wrote another one of your articles that we found very interesting. It was this using the ownership lens to select funds. And you actually wrote two articles. And it was kind of keying in on this. I think it was an academic study, either a paper or an academic study that was titled Judging Fund Managers by the Company They Keep. And I'm going to let you try to explain it, but it was a way to try to get at, identifying good performing funds, basically, I think based on their holdings. So is that something you could just sort of explain a little bit more at what that actually is trying to do and some of the Morningstar findings of that ownership lens?
You know how to ask a hard question. This is the best academic paper that nobody knows about. And the reason nobody knows about it is it's tricky to grasp intuitively. But I'll explain. This paper is from 2005. It was called Judging Fund Managers by the Company They Keep. And the idea was, if you look at an individual fund and you try to analyze the past performance of an individual fund, there's a lot of noise there, right? It's a sample size of one, in effect. There's one portfolio. This fund has one portfolio. And there's quite a bit of luck involved with whether the fund, it's hard to differentiate between skill and luck because you've only got one portfolio and one series of returns for that. Professor said, okay, how do we get a bigger sample size? Professors love bigger sample sizes. And they said, what we're going to do is we're going to look at the holdings of the portfolio. And we're going to count, we're just going to see who else owns these stocks. So if your first stock is whatever, Apple, we're going to see all the other portfolio managers that own Apple. We're going to weight it, so if they have a little bit of Apple, that doesn't count very much in our analysis. If they have a lot, it counts a lot more, and this is your top holding. And we're going to go through this process for every stock you own to see which portfolio managers are have funds that look most like yours, and which ones look the least like yours. The idea being that this portfolio manager thinks mostly like you, or your team of portfolio managers. And then we're going to see how those other funds do. So now we've got a really big sample size, right? It's not just one fund, it's all the funds. And if these other funds tend to do well in aggregate, the ones that look most like you, we're going to say you're a good manager because you're in good company. You own the same kinds of securities that successful funds do. If the other funds, the funds that look most like you don't do very well at all, and the funds that look least like you do really well, you're a bad manager. So we're judging you by the company you keep. That's the name of it. It's tricky to, it feels very circular. It is circular, right? Because the investments that you own, these other people do well in part because they have the same thing as you. So it's kind of like measuring you when we're measuring them. But it works. I mean, we know when I say it works, the professors had a 15, 20-year time period going through the early 2000s of the U.S. stock market, and they measured it, and they said, okay, well, this has some predictive value. We can take this at some point in time, say here are the best managers by our score and the worst managers. Then out of sample, that tended to hold true. There was predictability. And then we looked at a completely different data set after 2005. And it wasn't just the US market, it was other markets too. And it still worked. And it worked, it was very statistically significant with large differences in excess returns. We need to do more with this. I wrote that in my column, and we haven't. We haven't because, I think it's just not very intuitive, or it's difficult to explain, but there's something powerful there.